What is DeFi and why it's growing so fast? In this video, we're going to cover one of the fastest growing markets in the crypto world. This might be one of the biggest financial innovations in the last century. Before we start, please don't forget to subscribe or like this video, as that helps me make more videos like this. So what is DeFi? DeFi is a movement to make a new financial system that's open to everyone and doesn't require trust into intermediaries like banks. It relies on the blockchain and is built on top of smart contracts. DeFi is trying to create a new financial system in a permissionless way. That means that users can interact with the financial system without a trust third party like a bank. Users interact directly with smart contracts. DeFi includes different parts of the financial system. That includes decentralized exchanges, lending and borrowing, derivatives, margin trading, and even insurance. Most of the DeFi projects today are built on top of Ethereum, as Ethereum has a really strong smart contract language called Solidity. But there are other emerging cryptocurrencies like Solana that promise a much higher throughput in their network. One of the first projects in the DeFi space was MakerDAO. It was founded in 2015 and it was a platform for lending and borrowing money. The way it works is that it locks collateral like Ethereum and it generates DAI. DAI is a stablecoin that has incentive to follow the price of the dollar. From the creation of MakerDAO to now, there has been a huge wave of DeFi projects and around $70 billion of locked value. That's crazy. The big advantage of DeFi is that you don't need anyone's permission. That is, it's permissionless. You don't need anyone's approval to lend and borrow money, and you don't need anyone's approval to list your coin in a decentralized exchange. That's crucial, and that's why it's growing so fast. Let's go over each part of the DeFi ecosystem. First, let's go over lending and borrowing. There are a bunch of protocols in this space, but the most well-known are MakerDAO, Aave, and Compound. Compound is based on smart contracts, and they create a money market between tokens like Ethereum and stablecoins like USDC or DAI. Let's dive into it. To become a lender, you supply a token to the money market. Then the smart contract issues new tokens that represent the supply tokens. The lender eventually can redeem its supply tokens with the new issue tokens. The user that borrows money usually provides a token as a collateral to borrow more tokens. The user that wants to borrow money needs to provide a token that has a higher value than the loan that it wants to take. That is, the loan is over-collateralized. What is the point? Why would a borrower lock in more value to get a loan? Mainly, users don't want to sell their tokens to cover unexpected expenses. Another reason is to delay paying capital expenses or to increase leverage into a certain position. But there are limits on how much money users can borrow in a market. The first one is how much liquidity or money there is in that market. The second one is the collateral factor. The collateral factor is the amount of money that you can borrow given the tokens that you're providing. For example, Ethereum and DAI have a collateral factor of 75%. That means that if you provide 4 Ethereums, you can get back 3 Ethereum back borrowed. The borrowed money needs to be less than collateral factor times the tokens that you locked into the market. If for some reason the value of the token that you got increased in value past that collateral factor times the token that you have locked in the market liquidates your position really fast. What about APY? How is it calculated? It is determined by the market and it's calculated per Ethereum blocked, and it can change dramatically over time. There are some protocols like Aave that have a more stable APY in the short term and a more variable APY over the long term. Aave also offers flash loans. That means loans that last less than an Ethereum block and have no need for collateral. So let's take a look at the mechanics of how Compound works. Other protocols have other mechanics, but this is one of the most prominent protocols in this space. First, most tokens start with an exchange rate of 0.02. So that means that when you lock 10 Ethereums in the smart contract, you get 10 over 0.02 or 500 of what Compound calls C tokens, or in this case CETH. So you get around 500 CETH back. Over time the exchange rate goes up, and so you can get back ETH from your CETH at that exchange rate. So let's say it goes up to 0.021, then you can get back 500 over 0.021 ETH back. Or if you supply 10 ETH to borrow money at an exchange rate of 0.021, you get back 10 over 0.021 or around 480 CETH tokens. The rate of increase of that exchange rate is determined by the supply APY, and the supply APY is determined by the supply borrow money in the market. So if the exchange rate increases a ton over time, APYs are higher, and we can calculate that over a month or over a year. That's how Compound works. Other protocols use a similar strategy. So what are DeFi lending risks? First is the smart contract risk. There can be a bug in the code. Second is the quickly changing APYs. People can get liquidated really fast when API changes really fast. Now let's take a look at other DeFi space, decentralized exchanges. The most prominent projects in this space are Uniswap, Curve, and Balancer. Decentralized exchanges or DEXs are the opposite of a centralized exchange. That is, they don't have a sensor that needs to include a cryptocurrency for it to be listed in that exchange. There are two types of DEXs. One is the order booked based one. That's the most traditional one that you usually see in exchanges like Nasdaq. And the second one is the liquidity pool based one, and that includes Uniswap and Kyber network. Let's take a look at Uniswap, as it is the most popular liquidity based DEX in the market. So for Uniswap, users provide liquidity in the form of tokens, and they get liquidity tokens back. So let's say they provide Ethereum, they get back a liquidity token. When a user transacts using the Uniswap network, there is a 0.3% fee that's accrued on every transaction. That fee is evenly distributed between the liquidity token owners. If the user providing the liquidity to the network wants to get back their tokens, they must burn the liquidity tokens, and then they get back their tokens plus any accrued fees that the market generated over time. So let's say that I want to use a decentralized exchange and I want to trade Ethereum to Bitcoin. How does Uniswap work? So Uniswap uses something called automated market maker. How does that work? Basically, an automated market maker, or AMM, has smart contracts that determine the exchange rate between, let's say, tokens like Bitcoin and Ethereum. And how does it do that? So basically, the tokens in the smart contract always stay in a curve. XY equals K. The amount of Bitcoin times the amount of Ethereum always stays constant in this smart contract. Let's say that this smart contract has 20 Ethereum and 20 Bitcoin, and I give 5 Ethereum to this market. That means that before this transaction there was 20 Ethereum times 20 Bitcoin. That's equals to 400. After I provide 5 Ethereum to the market will have 25 Ethereum. For this product to stay constant, the smart contract will need to give me back 4 Bitcoin. So that 16 times 25 is equals 20 times 20. So I get back 4 Bitcoin in this smart contract. The amount of tokens over time for each pair changes over time, but always stays in this curve. And there's always incentive for it to become to a point where it represents the real exchange rate between these two tokens. Because if it moves outside of this point, there's an arbitrage opportunity to go back to this point and for people to make money. That's mostly how automated market makers, or AMMs, work. There are some other interesting protocols that are emerging in this space, including Hashflow. There are also other decentralized services. There is insurance, and the most well-known is Nexus Mutual. but there are other protocols emerging in this space. There are also oracles, and these are decentralized data feeds. The most well-known is Chainlink. I won't go into detail into these two decentralized services, but they are also very exciting. All in all, DeFi is growing at an astounding rate because it's open, permissionless, and cooperative. There are still a few risks in the market, and that includes bugs in the system, includes systemic risks, network fees, and even subtle changes in the protocol that can cause massive changes. But as we enter the era of Web 3.0, DeFi is gonna be here to stay, and it's gonna be a huge market. I hope you guys like this video. Leave any comments down below with questions. I hope you have a great day. See ya!